I am muted. Okay. So thank you everybody for joining us for our virtual business discussion. Today we are going to be talking about measuring profitability goals for a strong business position. Hi, my name is Lee Schwartz. Since March, we've held numerous webinars and counseled countless clients. I know you're all getting inundated with information via email and webinars, and we're all getting a little Zoom fatigue. But I want you all to know that we really appreciate you spending your time with us today, and we're going to do our best to make sure this is meaningful for you. Now, we've all heard enough doom and gloom over the last 4 months, so we're going to try to focus on giving you information that can help you get through this thing and come out the other side as strong as possible. From peeking at the attendee list, we've got a large and diverse group of companies on here. We'll do our best to be industry agnostic, so we're going to look at things through a few different lenses. Many of you are already clients of SVA, and we'd encourage you to reach out to your SVA contact if you have questions coming out of this. If you're not a client of SVA currently, and you do have questions, please reach out to me and I'll get you connected to a subject matter expert who can help. If you have a question during the webinar, open up the chat box in Zoom and submit your question to all panelists. We're going to try to keep this as interactive as possible, so I'll ask some questions as they come in, but we're also going to leave time at the end for Q&A. Also, we're recording this webinar today. You'll receive an email with a link to a survey, as well as our SVA resource page, where the webinar recording will be available. Now, if you've been on any of our webinars over the last several months, you're already familiar with them, but just in case, let me introduce Nancy Melberg and Dan Glomsky, both principals with SVA. Dan, why don't you take it away?
Great. Thanks, Lee, and I appreciate everybody attending. Today we have quite a bit of information to cover. Some of the information you might say, why don't we go into it a little deeper? We just don't probably have enough time to do that, but we're going to cover as much as we possibly can. And our focus primarily is trying to help us at least give you some perspective as how we might look at a business and what we are advising clients as far as how to create the measurements that help them determine how their business is doing, kind of sniff out some weaknesses that might exist, and really just a very good monitoring process. So with that, we're really going to talk about the business performance assessment. And the question that really should come to mind is, how is your business doing? And the reaction is, are you really able to make that assessment? And then how often are you making that assessment? So it's really important that, a lot of people go off of instinct, and that becomes very dangerous because instinct doesn't necessarily tell you where the problem might be. And what we want to do is kind of try to give you some ideas and thoughts as far as how to go about building or getting into that right data. The first piece is when we evaluate a client, we really start with the historical information. And the historical information, it could be 3 years, it could be 5 years worth of data. And what we're really basically trying to find out is how much or what kind of trends the business has. And when we look at that historical information, we'll look at that historical information and say, this was a really good year, this wasn't as so great of a year, and this was a so-so year. So within that 3 or 5 year period, we want to try to hit kind of all three of those opportunities to evaluate data. So we'll look at financial statements, we'll look at other data. It could be production reports, it could be employment records, it could be shipping orders. It's not just the financial income statement, balance sheet that you should really limit yourself to when you're kind of trying to evaluate the business performance. The other piece we'll look at is industry data. And we have a variety of resources that we pull on to try to come up with industry data that businesses can use to benchmark themselves, kind of evaluate how their historical performance has been. There's a couple things that there's two primary sources that we go and one is called IBIS World, and the other one is RMA, which is Risk Management Association. And they publish data that, really kind of identifies industries by sectors. And they use either an NAICS code, which is North American Industrial Classification Codes, or an SIC, and they're both, which is a standard industry classification code. Both of those are basically standard codes that are used to categorize businesses and industries. And it's important that you get the right industry, and we recognize that not all industries fit into your particular model or your business, but it should give you some reference point to work with. Additionally, reevaluate some kind of projection or goals of what your business objectives are, right? So we need to, if we say, how's my business doing? Well, that's relative, right? It's where do you want that business to go? And that's really what we also want to kind of leverage in this scenario. And then the final piece is, quality data is important. I mentioned accrual accounting. I mean, it's possible that cash accounting could also get you to an answer that you're looking for, but accrual basis is really designed to be real time, your activity, and within our analysis, we'll factor in the cash component of it. But the most important piece is the quality of the data. If the data is not good and has a lot of flaws to it, then our ability to at least rely on it, we need to know that weakness, and we need to adjust for that weakness if it does exist, and then work to improve it. So those are the kind of things that we would look at when we start our evaluation process.
Hey, Dan, I'm going to jump in here a little bit and just ask quickly, because you talked about industry data and the IBIS and the RMA data. I know we do a lot of benchmarking for clients. Can you talk a little bit about, the limitations of that and, false red flags, things like that?
Yeah, so, when we use, for this presentation, we'll use industry data to give everybody a little bit of perspective. The limitations on some of the industry data is the fact that some of the industry data might include only 160 companies, or might include 1,000 or 500 or more. The reality of it is you've got to be careful on that industry data. One, you need to make sure you're in the right code. And two, you need to kind of evaluate what you're trying to get from that industry data. A lot of times I like the industry data from a different perspective, because businesses are all unique. They all run their differently, and they have different management structure, different employees, different process, so many differences within a business within the same industry. But if you have that benchmark from an industry, sometimes it pushes you to maybe collect your AR in a shorter period of time, or stretch your payables. I hear so many times clients say, "Oh, I can't put longer payment terms on my vendors. They'll never go for it." Well, then when we look at industry data, the industry's paying at a much later rate. Why are you running into that problem and not these other people? And it doesn't mean that that's the right ultimate answer. That does just mean that it's something that we can push ourselves towards. So we want to be careful on the industry data, and it doesn't have to mirror your history or even your company at the end, but it's something to benchmark yourself accordingly.
So I would just like to just give a quick example, because this is something I was actually just having a conversation with before this meeting with a client. Some of the things too we have to be careful of when we're looking at this industry data is we don't always know the details behind it. So we're getting some summary information, not the details. And one example could be, in this particular one we were looking at, was something, I'm just going to use percentage of rent to income. And we don't know the situation behind that number, because I'm sure as many businesses, you could own real estate and you're determining what that rent is that you're paying to your LLC. So I think that's just an example of how those numbers can possibly be skewed And so we don't want to rely 100% on that. We also don't know, although there's some guidelines on what should be in direct cost or cost of goods sold. I've seen a lot of financial statements where they have a lot of information in operating expenses. It should possibly be in direct costs. So again, just things to be aware of when you're trying to compare to some of that data.
Yeah, those are all true points. So then from our assessment perspective, I want to go over basically the 4 major types of ratios, which are liquidity, leverage, coverage, and then operational ratios. And just kind of on the surface, look at them. These are all things that I believe are good measurements for your company. It's a very common, the ones that we'll share with you are the very common ones. But there's variations of these. And as Nancy kind of alluded to, the industry data doesn't necessarily, relies on people reporting data to them and how they group their costs of sales, what they include in inventory and that type of thing might be different than what your business is operating at, or might be different from the other people reporting in the industry data. So, there is definitely some weaknesses within the industry data, but again, it's again, a data point. So we're going to talk about liquidity ratio, and liquidity ratio is really your ability to pay for, pay for your debts that are coming in the short term without having to put any capital infusion into the business. So from our perspective, this is the ability to make payroll the following week or within the next 2 weeks, that type of analysis. And as part of that, we have the liquidity ratio includes the current ratio, the quick ratio. We have days in receivables, days in inventory, days in payables, and then sales to working capital. What we did for the presentation is try to grab some industries that have some diversity from each other. And the fact is, each business, because it's unique, has, and even within those industries, have different requirements and will result in different ratios as a result of their industry needs. So for example, the current ratio for the hotel and restaurant equipment wholesalers, they're operating, let's say, at 1.6, which means that they have, 1.6 times the amount of current obligations that are to be paid. So that's where they run. Whereas if we go to veterinary practice, let's say, they might not have as much, they might have more cash or inventory and maybe less obligations because they're not necessarily carrying a lot of inventory and those types of things. We look at also like days and receivables. If you look at the architect firm, might take, in this case, it's 70 days before you collect your receivables, and the machine shop is at 51 days, and then the restaurant hotel's at 33 days. And then we also look at the payables. Now the payables should be a little bit tighter. So here we're looking at 45 days for the architect firm, 32 for the machine shop or metal stamping, and then the wholesaler. And then you also have to remember some of the industry data doesn't exist for some business sectors. So you also will have gaps in that analysis. The one at the very bottom is sales to working capital. And the working capital is, it really kind of goes to Nancy's point of what's really in that number. And working capital, from my opinion, should normally be like your cash, your accounts receivable, your inventory, and then accounts payable, and maybe even a line of credit on any kind of funding of inventory and maybe receivable collections. So when you look at working capital, we're looking at basically what short-term needs the company has to continue to generate revenue. And this number is a number that will vary, and will vary again by industry. But I think if you're not following this type of need, I think it's something that you should follow because a lot of times this will also illustrate that we have excess working capital. And that's where our ability is to maybe save some cash and run things a little tighter.
So Dan, sorry, Nancy. So just as we're looking at this, you see a range of 1.6 to 2.0 for a current ratio, liquidity ratios. Obviously, a lot of other types of businesses that aren't included here. How would you go about, identifying whether or not a business has good liquidity ratios?
Yeah, so, the ratio, you definitely want to have a 1, right? If you're below 1, that's bad, right? So we like to have it around, 2, as close to 2 as possible for like a current ratio. And then the quick ratio, again, we're looking at the quick ratio is one that has more of the, here's how much cash I have, and then here's my current liabilities. So it's really kind of basically that's really my true. Can I make payroll next week and pay my vendors off? So that again, I'm really comfortable when I get a quick ratio at 1, and then my current ratio around a 2 is where I really believe we're really strong. And then the receivables and those also factor into how long it takes me to turn that receivable and the cash. Again, very important indicator of when maybe customers stall off, and we want to be, indicating that we have some activity there.
So one of the additional points that I was going to make is that another thing that I always tell clients is to try to get your receivables and your payables a little bit tighter, close together, because that's definitely going to help your working capital. In other words, your cash flow of the company. Because think about it, I'm going to pick on the architects here on the far right. It's taking them 71 days to collect receivables, but they're paying their payables in 45 days. So to the extent that that gap can be a little bit closer, it's always going to be a little bit better for a company's cash flow. Ideally, and I know that maybe Dan is going to touch on this a little bit later, but ideally, it would be nice if you could collect your receivables faster than you're paying your payables.
Yeah, and and also keep in mind that the payables, they're also sitting maybe in inventory for a while, and, that type of thing. So the longer that we can have to make those payables, like Nancy indicated, gives you some cash flow breathing room. But again, it's definitely areas where we really like to focus and kind of, that's why they're part of our dashboard, because we believe those are variables that we control by our maybe some additional effort on our part. Then the next ratio is the coverage ratio. And the coverage ratio is really the company's ability to service its debt. And there isn't, much to say on this one. The ratio that I like the best on this is really my net profit divided by my current tax long-term liability. And this really kind of just emphasizes my ability and my comfort level on paying off that debt. And as you can see, these are all pretty close amongst the industries, 4.6 to 3.2. If you're in the 3 plus, you should be in pretty good shape. But there's certain industries, if I were to pull like real estate or that type of entity, my leverage ratio is going to be much higher from that perspective. So we or ends up being a little bit lower and tighter because there isn't a lot, because we're highly leveraged. So that's one thing that you want to watch and maybe include in your system, especially depending on what kind of debt level you have. The third ratio is the leverage ratio. And this is the ratio that really kind of looks at our comfort level or our how our business is really structured. So am I carrying, what percentage of my, let's say I have 100,000 of assets, what portion of that do I want in my be funding through long-term debt, and what portion do I want to be putting my own invested capital into the business? And the reason that I say that is some of it is decision, because certain owners say, I really don't want any debt. And other owners say, I'm going to make this business thrive on its own, and therefore I'm going to load it with that. As an investor, it's cheaper for a company to have pay the return on a debt, because that might be interest at 5%. Whereas if I have an investor fund coming in, that investor might want to get 15 or 20%. So I have to generate more profitability in order to really meet that investor's obligation by having more of their capital money stuck into it. With that being said, if it's just, I'm the only owner and this is my business, I get whatever return I get. I'm not as concerned about getting that 15 or 20% return from the company. But it's a mentality that you should be thinking through and determine whether your company is appropriately structured and how does that company support that. So the primary one on the leverage is really how much debt to equity you have. And in this case, we look at the 4 sectors, and a debt to equity is 3.6 for a veterinarian. And what that really means is that the vet practice might not have much in the form of equity, because the owners have pulled it out in the form of compensation and that type of thing. And they might have a little bit of debt, let's say a line of credit. So it automatically spits that number much higher. So I think the 3.6 is probably more of an abnormality that I really wouldn't focus on. Whereas the 1.9, 1.2, 1.4 is, they're okay. The 1.9 gets a little high. We're looking at like 0.5 as probably the low side. And then you start, as you go up higher, you start getting a little bit more leveraged, and you got to be able to produce that return to pay for those debt obligations.
So I want to just throw in, a lot of times in conversations that I have with business owners, I will tell them to keep some equity in the company or save it for a rainy day. This is where these are going to come into play, because these are situations where, there's always businesses where the shareholders or the owners will take out 100% of the equity out of the company. And so they're not leaving much there in the event there is a downturn and they still have debt. So that's sometimes why you tend to hear us as accountants say, leave some equity in the company, save some for a rainy day, because you just want to have a little bit of that cushion for the future.
So Dan and Nancy, what would be a normal range then? I mean, as you look at economic ups and downs, what would be a normal range for your leverage ratios?
Yeah, so a lot of people, I think once you get to two times, and again, it's really industry specific, because I've also, I have clients that are, maybe a leasing company, and what they're doing is, they're buying assets and leasing them out, but they have it all financed with the bank with a good portion. So that the debt to equity can be 10, but normally in normal operating businesses should be around 2, and as low as, like I said, 0.5 is kind of where I like to see it. We start getting above 2, then I start getting a little bit nervous that the business might not have some flexibility that it might need to, whether it's I'm going to reinvest in some product line, whether I want to take some chances that a business owner might want to take.
And I think too, depending on the industry, you have to look at the volatility of that industry. I think when we look at what happened with a lot of contractors back in 2006 to 2008, you probably had a lot of construction businesses that went out of business because they didn't have the proper equity when the housing market crashed. So I think you really have to look at the volatility of the industry as well.
Absolutely. And then the third ratio, or the fourth ratio, is what is really operational ratios. And that's our ability to kind of see how we're doing, how's that revenue doing? What kind of costs, are we keeping our costs at bay, and those types of things. So this is really our ability to kind of see how we're doing from a performance perspective. There are standard operational ratios that exist, and they're really kind of driven towards the profit to equity ratio. But where I really like to get into it is the gross profit to sales percentage, right? So if, for example, in the restaurant, we're at 32% as a gross profit. Now, again, take it for what it is. If they're not grouping things in cost of sales correctly, not doing absorption, not doing overhead allocations, that can change what our numbers look like. But making the assumption that they're categorizing things similar to us, we have a 32% for the restaurant hotel wholesaler, whereas the metal stamping's at 34. But then we look at that compared to our ratios, and we kind of see how are we doing, and then that kind of forces us to drill into it a little bit further. The other true tale, and there isn't much variance in this one, right? So if I look at my net profit for my business, this wholesaler is doing it at 4.8% of profit, metal stamping's at 5.3, and the architect's 8.8. How are we doing compared to that? And that there isn't much uncertainty there, right? Because everything has to be reported on the income statement. And when we get to the bottom line, that's our profit. So that's also another good benchmark I like to pull from the industry. And it really kind of tells us how we're doing. But these are just standard ones. And this does not mean that you can't go and create your own matrix as far as what your business is doing and how it's doing. And when we get into the dashboard information, we'll kind of talk about, these other things that we think you might want to measure or monitor.
Great. Yeah. And that's so each industry is going to have their own KPIs and their own things that I know we'll get into, but I'm curious too. You talked about all these different ratios. What would you say would be a normal time frame that people should be looking at this and reviewing this? And let me ask that two ways. Like, all right, what's the normal time frame in the normal world, and what's a normal time frame now?
Yeah. So the frequency of the ratio first, I think, comes down to what you can get good data on, and I think so that's really your first start. And then, your assessment of, what frequency. You don't want too much time to pass before you get the data and be able to make a decision. And the example would be that, if I have, let's say, I'm running my gross profit percentage is down to 14%, and normally I was at 32%. I don't want to know that 6 months down the road, right? I want to know that, as soon as possible. And so if your accounting system has the ability to kind of do real-time data and all your transactions are current and your system's really built to generate it on a quicker frequency, you want to grab that information, although it might not be rock solid, it'll at least give you a barometer of how you're doing. I think you're comfortable there doing it on a more frequent basis. But you want to really push to get good data and as soon as possible. I do some of it, I'll have some dashboards where I'll do it on a monthly basis, some on a weekly basis, and then a quarterly. But I think you really, at a minimum, probably should be at a monthly basis and not too long after a month is closed. Nancy, you have any thoughts on that?
Sorry, I had trouble unmuting myself. Little technical difficulties there. No, I think you summed it up good, Dan. I think one of the points to make is really dig into your software a little bit, because there are a lot of softwares out there that have the capability of tracking this in real time. And I know in doing some research recently for some other clients that you can, if your software can't do it, you can even buy software that you can add some metrics and you can integrate that with your accounting software. So if it doesn't do it, this additional software can track it. So you can be really double checking these things in real time constantly. I know one of the softwares we work with updates it every 6 minutes. So you probably don't need to look at it every 6 minutes, but if you wanted to, you could.
Yeah, and I think when things were chugging along, the dashboards maybe fell a little bit to the wayside because nobody was really looking for a problem and was comfortable with how things were operating. Now we're running into a scenario where you're trying to look ahead, kind of putting in the past behind you a little bit. But I think you also want to look at when that trend's going to start turning around. And so now the more you are able to look at it at a more frequent basis, the quicker you're going to be able to identify trends that help you determine whether you're starting to move out of it in reality or whether it's an anomaly, right? And so that's where, the frequency at the current state, I believe you should try to push to get, something that you're measuring on a more frequent basis to determine whether what you think might be the case is actually the case, and what changes you've made, are they giving you the results you're looking for? And that kind of leads into the dashboard discussions, and where the dashboards from my perspective are really, a 1-2 page, maybe 3 pages. I really don't want to go beyond 3 pages. I really like the 1 to 2 max, where we really have key indicators. And this really involves sitting down with the people that operate your business and understanding exactly what you believe some of the drivers are. And a lot of times we'll come into that and we'll have the discussions with the owners as far as what they believe the drivers are, but then we will infuse some of our own thoughts just to get them to think a little differently, so that we don't continue to watch and monitor the same things. We kind of force people to look at other variables that might be contributors that they can adjust. Again, you're going to know your business the best. We just like to play devil's advocate from time to time. And then in the dashboards, we have the ratios, and I'm going to pulling those in. We pull in historical data, we'll pull in projections or budgets. But when we look at the budgets, that's where we have the ability to kind of benchmark ourselves with where we want to go. And we want to make sure that if we're way under budget or way over budget, that we determine whether the dashboard has, whether that's a useful benchmark for that current period of time. And where Nancy and I were talking about this is, maybe you have a year-to-date benchmark for budget, a monthly, budget, or weekly, or whatever frequency you have. But the reality is you want to make sure that dashboard and all the components on there are useful to you and help you make decisions. We also believe that this is an opportunity for you to evaluate your supply chain and your customer risks and your cost controls. So all these things, I think at this current time really warrant some consideration for a dashboard. And I'll go into some specific industries and some particular drivers that we would consider. But if you're looking at your inventory or your supply chain risks, to me, it's what products are coming in and how they're coming in on a timely basis. So maybe that's a new benchmark. Maybe it's, here's our products coming in, or maybe it's our key vendors and what amount is coming from them and what's going out. And by looking at the differential between the two, you can see, whoa, boy, we got 100 units coming in and we got 300 units going out. At some point here, we're going to have a problem. And that's where we kind of start to determine whether that supply chain is starting to fail on us and what our lead times might be. So you want to build the drivers in that. Same thing with customers, right? If my aging report starts stretching out further, hey, I need to make a change here. And cost controls, right? So you say, well, I'm going to reduce supply costs. And so then maybe that supply cost needs to go on my dashboard, and either I have a budget number or I have, it compared to last month to see if I had the reduction I was looking for. But again, it gets on one page, tells me how I'm doing, and we go from there.
So Dan, before you move on, I just want to clarify something, because I have this conversation with people all the time, and the difference between budgets and projections. So in my mind, a budget is something that you want to do, you're hoping to do. It's what you're striving to do, your goal. A projection is where you're headed. So very different. A budget, what you want to do, a projection, what you will do. So they're not necessarily one and the same. So I encourage companies, budgets should be prepared well in advance of the year. Projections are updated throughout the year. Budgets don't change. Now, with that being said, you could have multiple budgets for different scenarios, but once a budget is set, it doesn't change, and you report variances between budgets and actuals. But projections should be updated to always determine where the company is headed. So I just wanted to clarify that because I think it's important for companies to have both and to really be monitoring those. And regardless of which one you put on your dashboard, you need to have both and be looking at them regularly.
Yeah, I think that's a great point, and you want to make sure that that those are well thought through. And Nancy will later on go through the break-even analysis, and I think that's part of the process. So what we did is we grabbed the 4 types of industries that we presented in the ratio data, and the first one was the wholesale industry. And I just threw out some other marketing or some other dashboard possibilities that you want to, evaluate here, right? I want to look at my total sales. Here's where I said that my inventory received and then my inventory out. And I say factored, and that the reason I say that is because if I ship out 100,000 of sales, well, only a fraction of that is actual material cost. So let's say, I had a 50%, markup on it or whatever. Well, I want to factor it to bring it down to basically my received quantity levels. But if I factor the 2 and I bring them together, then I can at least see that differential of what's coming in and what's going out. And if they're not matching up, I know I've got some kind of supply problem. And then, sales by department, sales by units. Again, these are all things that you've determined as your organization that you wanted to monitor, you want to push, and you want to be focused on. So they're on your dashboard because if something's not right in them, you want to make some kind of decision or be aware of it. And then customer aging, it can't say it enough. Taking a look at that how a client's doing as far as their paying goes may require some follow-up, but at least you'll be aware of it. And we go into having clients say a dollar amount over X threshold, gets reported on that dashboard report so that that person knows what kind of customers out greater than whatever 90 days, 60 days, whatever you believe is a point where you're concerned collection will go away. For the veterinary practice, here it's patient visits per day, per week, per month, whatever frequency and whatever data that you have available, we want to be able to utilize. Revenue by employee, what's the production numbers? Is there, a person that's seeing more patients than another? Maybe that's something that you'll be able to leverage, or maybe somebody's not seeing the number of patients that you thought they should. A lot of things there. Collections, right? What cash is coming in, and here's supplies purchased, right? If you decided, wow, our supplies are really getting out of hand as far as what we're purchasing, well, let's throw that on the dashboard and let's watch it. Let's see if we can, make some decisions on how to, control it, and then let's see if we actually get those results. From a manufacturing perspective, here is, total productions by unit, maybe by shift. Our waste products, active machines, production hours, again, revenue by employees. And I think you can look at revenue by employees in a lot of industries. And where I like it, it kind of just tells me my benchmark as far as whether I have the ability to add more people and what kind of revenue generation that could create, or if we look at over time, my revenue by employee starts to drop off, well, maybe I have too many employees and I need to refocus or retool that type of decision. So I like that benchmark from a production perspective. And then finally, professional service. And here it's, again, revenue by employee, days in accounts receivable aging's above a certain dollar amount, how much is my billings, what's my cash balance. And these are all things that will at least give you some idea of where the organization is going. Now, just because we say these, and I got a couple of sample dashboards to show you in the next slide, but just because we say that, that doesn't mean that that's what your business needs. What your business needs is what you want to focus on and what's going to take you to either hit that break-even analysis or whether it's going to hit your goals. But you want to put on the dashboard what is productive in your particular industry or business.
So that I was actually going to bring that up, Dan, that you really want to think outside the box a little bit on this. So don't think that this has to be all generated from financial data, because there are a lot of things that you can incorporate financial data into with non-financial data. So one example that we did for a particular client, a hospital, was net income by bed occupied. So that's something that a hospital, they always know how many beds they have occupied at any given point, and maybe that's something that they have a target on. So you got to really think outside the box and look at your organization and look at things that are important to your organization that maybe are non-financial but lead into that financial information. So just something to think about there, because every industry is going to be different.
Absolutely. And then, so the first sample dashboard, and I'm just going to quickly go over it because it really doesn't mean much other than here's an illustration of what we kind of put together. But here in this particular one, it's a service business. We're watching cash flow, and then we're watching cash flow compared to last year at this time. And then we look at, you know, when their billings are, how much their billings are, how much production I'm getting on a weekly basis. And if you look at, you know, on the far left bottom corner, it says weekly WIP, and you see a big variation, right? I have the same amount of professionals every week that are working, but yet one week I have $55,000. Next week I got 90 some thousand. That just means that somebody's not posting their time currently, or somebody's working tons of hours and nobody's working, you know, that type of thing. So it's really kind of an indicator that management can then go back and say, hey, get your time posted, you know, we're starting to run short on production. So, and again, we tap on the aging and our cash flow. Then the second part of this illustration is also just some graphs, right? We look at accounts receivable trend, WIP trends, and, you know, cash collections, and we throw them into a graph to kind of ballpark how we're doing. But when you see a big drop in like accounts receivable, then it's like, hey, we didn't get enough into, you know, we didn't convert our WIP into billing. And then you can see that, so the WIP's running high and the AR is running low, where we got to balance those two. And then all of a sudden you see the AR going up and the WIP goes down. And well, that means we're not replacing the WIP. So we have to, you know, this will give us an illustration of what lever we're trying to pull to try getting the things back in line if possible. All right, so then what we'll do is we'll quickly talk about the, Nancy's gonna go into break-even analysis, but to me, that's, you know, that's where our another dashboard component feeds into this. Things that we make in a decision process from the break-even analysis should probably be factored also into whether I include in my dashboard.
So thanks, Dan. In the interest of time, because we want to leave some time for questions here, I'm going to go through this fairly quickly, but I want to let everyone know that we can absolutely help anyone who would like help in putting this break-even analysis together. I know we have on here that this is important in times of uncertainty, but I actually think this is important to every organization to have this. There is no reason why you should not have this information. And really what this does is this helps you determine the level of sales that you need to cover your expenses and your debt. And this is something that you kind of work backwards on. And it's something that you can certainly say, I want to make. If you look at this particular example, we actually did it at a break even. So the bottom line available income is 0. But we have different templates we can use that we can back into this number. So if you say, my goal for this company is to make $500,000, we can put in $500,000. And what we really need to determine in here is what are your operating expenses? What are your fixed expenses, which are in operating, your rent, administrative, things like that. Really, really important in this is to understand what your gross profit is. because that's kind of how we work into the sales. And so every industry is going to have a little bit different gross profit margin. It's going to be very specific to that industry, but that's really how much of my sales is directly related to these costs. You know, a distributor's easy because you have inventory. You mark up your inventory. Those are your sales. Your direct cost is going to be the cost of your inventory. But for other industries, this number is going to be different, and there's going to be more information that goes into there. Once we can determine what that gross profit margin is, in this particular case, we're looking at a gross profit margin of 18%. We know what your overhead costs are, and that's a process that everybody should be going through. And then we back into that and we say, based on these overhead costs or fixed costs, this gross profit margin, sales need to be, in this case, $862,500. Then what we can really drill down deeper is we can break that down based on your average. How much is your average transaction? How many average transactions do you do? We can actually take that number then and break that down to a per unit sales, a per day sales, a per week sales, a per month sales. I use this a lot for clients to put incentive plans in place. If you're a retail organization, for example, if we break that down to the unit sales per day, they can go to their salespeople and they can say, for any sale over this amount in any given day, everybody's going to get an X amount of a bonus. So these can be really, really good to help you lay out these bonus plans. The other thing they can be good for is to really determine if there's a problem. I had a situation where I was working with a client and they told me that this is their overhead. We knew their profit margin. And when we backed into the sales number, they said, based on capacity, there's no way that I will ever reach that sales number. It's just not possible. So then we have to really sit down and we have to figure out why. Are our direct costs too high? Do we need to increase our sales or reduce our costs so our profit margin is higher? Do we have any capacity to reduce overhead costs? So this is where you got to really, really dig into it. But it's important to start with something, to build a template, build it based on the parameters you want, the income you want, maybe what the shareholders want to take in a wage. All that can be built in here, and then work backward to figure out what are those sales numbers need to look like, and do you want to break it down to a per unit? These are extremely powerful, and I highly recommend, if anybody doesn't have this put together, to start working on it. And like I said, it's something we can certainly help you with, but I think it gives you a lot of insight into what those numbers need to look like.
Yeah, I agree. And I think the other thing is when I have a kind of categorized fixed and variable costs. And the piece here is that if you're going to treat something like a variable cost, you know, based on the sales volume, it's going to be this much in cost. And part of that variable cost is your employee cost. Well, you can't, then if your sales drop down, you have to reduce your employee cost, or it's not a variable cost, it's part of that fixed. So you have to, you know, be disciplined too in the calculation to include it in the right category so that you're doing a fair break-even analysis and you're not, you know, kind of manipulating the results. So that's basically what we have from a presentation perspective. I don't know if there's any questions, Lee.
Yeah, actually, I did just see a question from one of the participants asking about the break-even analysis. Does it have to be done by part, or can it be done by the company as a whole? Absolutely, it can be done as a whole for the company. I think the idea is to just figure out what that top-level sales number needs to be, determine if you need to start tweaking any of your overhead costs or your fixed costs. And then I think if you want to go from there, that's where you can take it to the next level and start breaking it down. Either break it down by unit sales, break it down by number of employees. That's where you can start to drill down a little bit more. But the first goal in this is to do it by company.
Okay, great.
So hopefully
Thank you.
I answered that question.
Dan and Nancy, thank you for that great content. We covered a lot of ground. We've already had a few questions come in, and we'll get to those in just a second. Please open up the chat function in Zoom if you do have a question for Dan and Nancy, and We'll start taking them here in just a minute. I'll just let you all know too, if we don't get to all the questions, and I imagine we may not, that we can reach out to you afterwards, or you can reach out to us and make sure we get answers to your questions. So one of the questions that came in, Dan, is about the ratios. So talked about, you covered several different ratios. Is there one ratio that's more important than the others?
Yeah, that's actually a really good question. So there's 4 different categories for a reason, and they're all kind of benchmarking or looking at different things. So it's my belief or my philosophy that I really want to incorporate, at least one of the ratios from each category to give me some indication of liquidity, my coverage ratio, how am I doing operationally and leverage wise? Am I starting to lose ground on that leverage front? So all 4 of them tell you different things. So in my opinion, we want to include, a component of each one to really have a true global picture of your organization and not just be focused on, well, I'm just going to focus on liquidity. Well, liquidity is kind of more of an immediate thing and not a long-term play. So, eventually it'll show a problem, but it probably won't show it quick enough for you. So that's where you want to be, very cautious on just limiting yourself and making sure you include what you need to.
Okay, another question that came in, I guess all about reporting. This is what we're talking about here today. Does QuickBooks have the ability to do this type of reporting in dashboards?
QuickBooks does have some ability, but a lot of it is very limited. I know that with QuickBooks, you can export information out and manipulate it, but that information is not, I believe, static, or it is static. In other words, you export it out and it doesn't automatically update as information changes. So it becomes very cumbersome. I know that there are a lot of other softwares out there now that are building dashboard and metric capability into them, and you can get extremely creative with them. I just don't think QuickBooks is quite there yet.
So Nancy, your recommendation, if you are on QuickBooks, is look into some separate dashboard software.
Absolutely. And there are, the one thing QuickBooks does very well is they integrate. They play nice in the sandbox. I always tell people QuickBooks does well integrating with a lot of different softwares. And you could probably even go to their website. You could probably even look and see if there's any specific software that integrates with it. I'm sure that you could probably find something.
Okay. Do you have any recommendations for that?
Not specifically for QuickBooks, no.
And what about more generally, because obviously I know we have a lot of clients on QuickBooks, but Sage and other, can you talk about, some of the more basic accounting softwares, what their capabilities are and what you'd recommend depending on, if they're not on QuickBooks?
Yeah, one of them that I like for a client that's looking for a lot of this information and a lot of things that are what I call outside of the box type reporting. We do deal with a Sage product called Intact, which is a cloud-based product. It is an ERP system, but it is very scalable. But that's one that I always tell people, if you're generating a lot of information outside of your accounting software, if you're needing to export things to get information, or you have Excel spreadsheets that you're calculating, that's the time when you probably want to look at something that has a little bit more robust capability, because at the end of the day, I think people end up spending a lot less time because the information is already there and it's already pulling what they need, and the ability to customize reports and the ability to think outside the box. Some of these software, especially Intact, this one that we deal with, can certainly do that. And that's the one that will refresh every 6 minutes. So you're getting the information in real time. So I certainly think there's a lot of options out there for people. And again, QuickBooks is probably one of those options, but if you're feeling like you're outgrowing it, there's a lot of other options available.
Yeah, you should also remember that, data is the new oil. So if your system's not be able to capture the data, you're really losing a lot of, benefits that, the world of mining as far as data goes, that's what's driving everything, data, right? Analytics and so forth. So make sure your system has the ability, and if you don't have the data readily available to you, a lot of things ultimately don't get calculated or don't get looked at, or it takes too long to do so. So those are all things that you want to keep in mind as you're evaluating, how to go forward.
And at the risk of being self-serving, I know a lot of businesses, depending on where they are in this process right now, may be looking to not necessarily elevate costs, but can you talk about how often you generally recommend people sit down with their accountants and review this stuff?
Yeah, so I recommend with all of my clients that we meet quarterly. And, it's interesting because a lot of times we may think that we don't have anything to talk about, but I guarantee that when we get together on a quarterly basis, we walk away with a pretty significant list of action points of things that you may need to do and things that me or SVA needs to do in order to help. So I think quarterly is pretty important. Now, there are clients that just don't have that capability of meeting quarterly, but definitely twice a year is pretty important to be sitting down with your accountant. I would think most people are doing that anyway, but if they're not, you should be.
Yeah, and I think even if I don't meet with a client, I might get their financial statements on a monthly basis. We might take a look at them, might share some thoughts, but also keep in mind that re-infuse a level of independence into that process where we help maybe see things differently or ask questions that might either elevate an issue or might offer some kind of solution and the ability to advance things in a different direction. So, we're, our role is not necessarily just, taking the financial statements and turning it into a result, but it's really that, again, if we might have 10 other clients that are in your similar industry, and, that's another set of data points that we can leverage off of.
Great. Well, we are nearing the end of our time, and I want to be respectful of everybody's time. So we're going to wrap up here. I think the one other question that we had come in, and I can just address it real quick, is somebody's asking, where do we get this industry data? And I think, Dan, you mentioned IBIS and RMA. We do have access to that. And if you want to reach out to me, I can run some brief reports and just email them to you as long as we have a NAICS code or an SIC code. Yeah, feel free to do that. We're happy to provide some information so you can look at your specific industry if it's available.
Yeah, the other thing I want to bring up too is there are a lot of industries that have groups that get together, and they can be very, very specific. I highly encourage everyone to look within your geographical location for groups within your industry that might get together, because a lot of times they share that information and you may have to pay a membership fee, but that information is usually extremely valuable. I know that they provide it with a lot of different industries in this area.
Yeah, great idea, Nancy. All right, so as we wrap up, I'd like to let you know that SVA has created a resource page, which is svaaccountants.com/back, where the recording of this webinar will be located, as well as additional information and updates on getting back to business. Our next webinar is coming up on September 17th, and we'll be talking about economic indicators for businesses. It should be really interesting. We'll have a couple of members from SVA Financial Group's investment team talking about what's happening in the markets with the election at that time being a month and a half away. And most people don't know this, but there is an election coming up in November. I'd like to remind you on the webinar that the SVA team is only a phone call or an email away. So if you're a client, again, reach out to your SVA professional as questions arise. If you're not currently an SVA client, contact me, Lee Schwartz, so I can get you the help or the answers that you need. And again, you can reach out to me for that industry data as well. We're here to help, so we're happy to do it. Thank you again for joining us today. Have a great rest of your day, and we hope to see you at our next webinar next month.